Today on It's the Economy, we try to get the expert view on all the rush of July data, in fact, June and July data that we got in the first 2 days of August. Direct tax collections very strong at 15% for April-June. Government capex even better, growing at 60% April to June. Core sector for June excellent at 8.2%. But now the July data. Two-wheeler sales dismal, down 14% in July. Car sales unimpressive, especially entry-level cars, which are still contracting. Separately, July inflation may come in at a shocking 6.5%, thanks to tomatoes, but not only tomatoes. To make sense of all this, I have with me Pranjul Bhandari, Chief India Economist at HSBC, and Abhishek Upadhyay, the Senior Economist at ICICI Securities PD. Pranjul, Abhishek, thank you very much for joining me. After giving you a lengthy introduction, I'm going to start with something which was not in the syllabus, the Fitch downgrade. Abhishek, well, the rupee is a little weaker, but is this something markets should worry about at all?
Well, if you look at the initial reaction of US bond market, for instance, it's quite muted. I mean, so if you compare this response to what happened in 2011, when in August S&P downgraded US, and that was a shocker. And then between August and September, US 10-year bond yields came down about 100 basis points. And dollar index also, which used to be around 70 levels, much lower than current levels, had actually gained 4-5% in this period. So the key uncertainty that time was whether various model accounts which have AAA only mandates, for instance, will be forced to sell assets because of the way covenants were structured that time. It appears there has been a lot of rewording which has happened in the legal contracts, and those adjustments have happened, which is why I would expect, the response to be much muted this time. In fact, the theme currently is that US economy is holding on much better compared to what many had feared. So I don't think this development really changes the narrative substantially on its own.
Actually, you put your finger on it to guide us and our viewers that actually at that time yields fell. More people bought treasuries and more people bought the US dollar in a flight for safety mode. And so the reaction was quite the opposite, which seems to be working today, the dollar index higher. But Pranjul, Abhishek referred to actually the resilience of US growth. US GDP, both in Q1 and Q2, was expected to come in at well below 2%, 1.8 for Q2. It came in at 2.4%. With that backdrop, we were all expecting that there are headwinds for global growth to India. That's not seeming to happen. Your take on India growth?
Yeah, thank you, Lata. So look, I think the growth inflation mix in the US has actually improved. Risk sentiment is better than before, than we had seen for most of last year. We are seeing this, decline in the dollar, which is great for emerging market currencies and their stability. In fact, even in the latest PMI data we saw that the new exports orders, goods orders, have actually risen quite meaningfully. So I think generally speaking, all of that is good news. But I think we're not out of the woods yet. This is great, but there's still a lot to go. And for two reasons, I think India's GDP growth could still get impacted negatively. One is, if global growth is to be stronger than we had thought earlier, then commodity prices will also rise. In fact, we've seen a 5 to 10% increase across the board in global commodity prices over the last couple of weeks. And I think that really can impact India, corporate margins, tax collections, consumer purchasing power via core inflation. So I think, that is something that we cannot sort of discount at this point. And a second area is, net services exports. Now, remember, we've spoken about this quite a lot, that it has been a huge driver of growth in the last year. But because some parts of the developed world still look a little fragile, for instance, some part of the banking sector, my general sense is that IT services this year will be a little bit challenged. And if export services growth were to fall by 10 percentage points, say from 15% growth to 5% growth, it can immediately shave off 1 percentage points from India's GDP growth. So we're not out of the woods. We have to be careful about where commodity prices are going, and also some other parts of global impact on India, for example, services exports.
Okay. No, I want to come back to that core inflation point you're saying. That really, I want it to be the meat of the discussion. But growth is interesting. Abhishek, how are you looking at the various growth numbers? US growth and of course even India growth in the first quarter of the current calendar hugely surprised. Everywhere GDP is surprising to the positive, India and US. But look at the early July data, look at the fiscal data. Direct taxes up 14%, core sector, PMI. So is it looking like there is some meat to push up growth forecasts?
Well, so construction sector clearly is doing well. That has been a big positive, and partly because, as you mentioned in your introductory remarks, Center has been spending substantially on capex. At the start of the year, there were doubts about whether Center will realize the very strong budgeted growth for capex this year, but 59% growth in the first quarter, and most of it geared towards railways and roads should lessen those fears. Not just Center, even capex by states, which has been lagging otherwise over the all through the pandemic, has started to pick up. So state capex is up 25% in April, June. So construction sector clearly, is fine. And as you mentioned, tax collections also, not just tax collections, credit growth, which is stayed quite resilient, GST collections. And these numbers have been strong despite, nominal GDP growth likely to have slowed down substantially. Because if you're looking at April, June GDP growth, it is possible nominal GDP growth could be lower than real GDP growth because of the deflator. So growth numbers holding up well. The issue for me, which Pranjul alluded to, is exports. Real exports, if you see on GDP basis, last year were up close to 14-15%. This year, we have already seen some weakness in exports, despite all this talk of soft landing. And commodity prices. So what you had for much of last 6-12 months was DMs were doing fine and China was weak. So that kept commodity prices low despite global demand, being reasonably strong. What you have now is the share of China in this overall growth impulse is rising. And that means higher commodity prices, which can have an adverse bearing. So, both exports, which are a big part, and you've seen services exports flatline in June, and commodity prices, still not a worry, but could become a bigger worry. And that is why we were never very pessimistic on growth, but we don't feel inclined to revise up the growth projections from 6% forecast that we have currently as well.
Pranjul, you were below 6, right, in your GDP forecast. You don't see reason, looking at the direct tax collections or core sector or government capex to increase your GDP number?
Lata, no. Our GDP forecast for the year is 5.8%, and I'm very happy to be there. Abhishek and you focused on all the positives that we saw in the data in June and July. Although you did mention about car sales, I found 3 sources of fragility also in the data that we just got over the last couple of days. I think number one was corporate margins, which you can glean out of PMI data. Corporate margins finally slipped to the negative in July on the back of rising commodity prices. So I think that's one thing we cannot ignore at this point. The second is the services exports data that I spoke about, that it's weakened quite a bit already. That's the second data that we got. And the third, the most important, is on fiscal tax revenues. Now, GST tax revenues are doing very well. Income tax revenues are doing very well. But corporate tax revenues have not been doing well over the last 4 to 5 months. And we cannot ignore that. GST tax revenues and income tax are actually great indicators of a K-shaped recovery. Because when the rich, they consume high price items, GST revenues go up. The formal sector pays income tax. So when they are doing well, the income tax goes up. But then why aren't we seeing the same excitement in corporate tax revenue? And I think we cannot ignore that. I think what's going on there is that corporate margins per unit have risen because commodity prices fell, but volume growth in many parts of the economy is very weak. For instance, rural. And I think with one sector, rural, not doing well, while urban is doing well, I think that is keeping a lid on corporate tax revenues. That is a source of fragility for me. I'm already seeing it in the data. But if El Nino were to hurt rural incomes going ahead, then I think that will become more and more obvious. Okay. So these are some fragilities I'm seeing in an otherwise pretty strong backdrop, because of which I don't think I can, do an upward revision to my GDP growth forecast for the year yet.
Okay. But I am sure both of you are going to do an upward revision to your inflation number. Since I'm running out of time, quickly into that, Abhishek, tomatoes, but not only tomatoes. What is your inflation number for July and the full year?
Well, Lita, so tomatoes itself can account for about 1% of headline inflation in July, which could potentially print above 6.5%. But yeah, it's not only tomatoes, as you say, because cereals prices have also gone up. But again, we have to see the impact of this rather proactive ban on rice exports and the pickup in sowing activity, which has happened recently on prices maybe over August, September months. But underlying inflation for me, I mean, remains fine. I mean, if you look at CPI ex vegetables, it should be around 5.2, 5.3%, where it has been over the last 3 months, and much lower than above 6% levels that we used to see over the pandemic. Core inflation momentum, 3-month annualized rate is tracking 4.5%. That is even lower than the YOY measure of core inflation, which is at about 5.1, 5.2%. So, I mean, I'm not changing the H2 inflation forecast per se. But yeah, near term, I mean, July, September inflation may track 6%. Yeah.
Okay. Pranjul, very quickly, I'm sorry, out of time, your July number, full year number.
Yeah, I think July inflation is going to be very high. We have it at about 6.9% at this point. After that, it goes down to 6.3%. And by September, we hope it comes down to about 5.2% once a new tomato crop, a new vegetable crop comes in. But the next 2 months are going to be very high inflation numbers. And I think we will hear that hawkishness in the RBI commentary on, on next week when the RBI meets.
Okay. I hope I can get you all before the RBI policy to check out what you will watch out for. But yes, how much will tomatoes prey on the governor's statements? Will it tilt him towards hawkishness, or will he stay even? That's what we will watch out for. Thank you very much for a rushed but extremely enlightening chat, Abhishek and Pranjul. We have to wind up on the note that the Nifty breached below 19,600 for a smidge only. Let's see. It seems to have taken support there. Chartbusters takes the action forward.